Hi there, this is Markets Tomorrow. I'm Neeraj Shah. Before we talk about what happened in the markets today, I quickly tell you what you will see on the show and the people that you will hear out on the show today. Manish Sonthalia, VP and Fund Manager of Motilal Oswal Asset Management, to speak about his preferred ideas. Nipun Mehta, Founder and CEO of Blue Ocean Capital Advisors, will be speaking about the fundamentals as well. And on the technicals, we'll have Prakash Gaba of prakashgaba.com. Gentlemen, all three of you, thanks so much for joining in. Manish, come to you first. In the last 2 weeks, we've seen quite a bit of volatility, a lot of back and forth action in the mid-cap space though. Are Indian markets now starting to underperform the global markets despite their FI flows?
I think the moot reason is moot causes due to very tight liquidity situation. And fundamentally, I don't see too many reasons for the markets to fall significantly below the levels to which they went. But the fact remains that liquidity is very, very tight, and DII selling continues unabated. I think some of these factors could be mitigated in the coming few weeks, on top of pretty decent earnings season that would conclude tomorrow or day after tomorrow. So I think I remain positive on the markets.
Nipun, there has been carnage in the mid-cap end of the market particularly. I mean, take real estate, talk about some of the infra names, all of these have corrected. What explains this pessimism, one, and do you think the weakness in particular the high beta names would continue? Say, for example, real estate.
To answer your second question first, I think yes, the degree of volatility and downward momentum or selling pressure could continue selectively, not necessarily, you need not maybe generalize and put it across the entire space, because if you really see even space like real estate, selectively there hasn't been too much of selling. DLF, for example, or Anantraj really haven't seen the same kind of selling as some of the other more high beta stocks have really seen. But when you look at the entire space, the entire mid-cap space, I think it's a mixture of a lot of factors. Very clearly, a lot of profit is being taken off the books, off the table really. You had seen a significant run-up coming in the latter half of 2012. A lot of that is being taken off the table. Secondly, very clearly there are likely to have been some margin calls that are happening as and when there is a market correction. There are a lot of promoters who've pledged their shares. You're seeing a lot of selling happening in a lot of those counters. But I think overall, clearly there seems to be a weakness as far as the mid-cap space is concerned. The daily advanced decline ratio clearly showing that the mid-cap index clearly showing a significant underperformance in comparison to the large-cap index that is there. But I think overall, the retail participation is being extremely limited. You are seeing domestic institutions selling all around, and you are seeing a fair amount of both large cap and mid cap selling happening there. Results haven't been too encouraging as far as the mid cap space is concerned. If you compare them with the September quarter results or with the June quarter results, the results really haven't been too encouraging across the mid cap space. So that's another reason probably you're seeing a fair amount of selling happening. And unless that turnaround really shows up in the March quarter results, you could see that continuing.
Probably the bigger reason that the numbers maybe with the large cap started off with the bang, but somehow it hasn't percolated onto the mid-cap space or possibly even the large-cap space. Nipun, the kind of reaction and the thumping that the market gave to the UB Group stocks today on the news that came out late evening, and I mean two worries. One, for companies like UB Holdings or the holding company which have given unconditional guarantees, but for a United Spirits as well, which comes into pressure by virtue of the fact that there could be shares of the company which could have been given as pledge and therefore could come into selling too. Does this, until this blows away, do you think the overhang persists on the entire group?
For sure, and I distinctly recollect my mentioning about this for the entire space. I think there very clearly, when you look at the kind of collateral that banks take, that banks would typically take, there would be a cross connection in terms of virtually all assets that the promoter would have, and that would include a lot of real estate, a lot of liquid shares that could be there. It could be a lot of personal property as well as corporate property that is there, and there are significant cross holdings when you look at this entire group in terms of either United Spirits or Bangalore Refineries or virtually the entire space that is there across the 4 or 5 listed companies that is there, and a lot of that could actually come up for selling if the banks do exercise the collateral in terms of liquidating a lot of those assets. So when you look at assets like goodwill and even that likely to be sold, I think that what you're likely to see is, despite the Diageo deal actually happening, you could see a fair amount of asset liquidation that could just come about, which could make it extremely difficult for the highly leveraged group to actually come out of the kind of problem that is there, unless a lot of the Diageo deal cash is actually utilized to repay some of the banks, which is really not happening, and which has been the concern since almost the last a month or so, since when the deal has actually happened. So yes, I think that ripple effect could just happen across the entire group in terms of the cross holdings that are there in terms of both liquid as well as real estate assets.
Just explains the kind of carnage in the mid-cap space. The first two questions on the show have been about, mid-caps. But not to forget the large caps. A couple of these pockets did very well, and IT in particular, a large cap IT, HCLTech, the top gainer on the index and up and about, TCS following suit. Prakash, on the charts, how do these IT stocks look? I mean, a 2% gain for a TCS, 4.5% gain for a HCLTech, trading at new highs. Do these stocks look like they can go up further?
Well, some of the stocks can go up, Neeraj. Structurally, I would say that except for HCLTech and TCS, I don't think there's much traction in the IT pack. I would say that TCS is certainly looking good. Very strong support around the levels of 1400. It needs to stay above the levels closer to around this 1440 or so. Once that happens, Neeraj, I think you can go to 1470, no doubt about it. As far as HCLTech is concerned, it's seen a massive up move. But then I would say it can continue up to around 750 or 740. But others, I would be slightly hesitant, except for just HCLTech and TCS.
Manish, I want to come to you. What's your view on the entire realty space? I mean, Unitech aside, there are some others which are seeing some major declines since yesterday. Is there buying into any of those that you would consider, or is it a blanket avoid call?
No, I don't think it is a blanket avoid call, because, given the restrictions that are now quite imminent in the gold space or the bullion space as a whole, money would tend to move into real estate more than gold, over the last few years, whatever we have seen. So I think real estate and stocks would be the favored asset classes. And given the spate of launches which these guys are having all over the country, I think cash flow positions, bookings, and the prices to earning multiple re-rating is also there on the cards. So you should be looking to buy some of these real estate names at low levels.
Which one of them, Manish? Which one of these real estate stakes amongst the some that you mentioned is the question?
I mean, you could look at, in our portfolio, we have an exposure to Godrej Properties through Godrej Industries. Shobha is also quite a good name. Or, let DLF come out with numbers as to whether DLF is really turning the corner in terms of their margins and whatever they have to say on what sort of launches they're going to see for 14 and 15. I mean, that looks a good buy, I would think.
Nipun, I don't know how much can you comment on these, but a bit of a sedate start for the new kid on the block in terms of the new bourse, MCX SX. And maybe that, or maybe the run-up that has had an impact on both of these. They kind of form a space in themselves because there are not too many competitors. If you track them at all, what's the view? Because after that initial run-up in the lead to the launch of the exchange, they've come off quite rapidly, both Financial Technologies and MCX.
Well, I think that the run-up obviously was in anticipation that all the approvals had come through and operations would start. You've actually seen that happening now. I think till you start seeing greater traction in terms of volumes, in terms of more members being active, in terms of revenues getting generated, very clearly I think it's not going to, in this business, for the first year or two, it's not necessary that you're likely to be making significant profits. So unless there are significant volumes that members start generating, and some part of the capital market, both it could be debt, it could be equity, it could be IPOs, it could be secondary market, either if some portion of this segment actually shifts from the two existing exchanges onto MCX, then you're likely to see a run-up, failing which I think that upward momentum that one had seen is likely to get tempered, and you're likely to see a sideways movement in both these, unless also partly if the capital markets actually move up significantly, and that could be a sentiment booster as far as the company is concerned in terms of potential for building up volumes sooner than later. So unless these contingencies happen, you could just see a sideways movement in both these stocks.
Okay. The other one, Nipun, that I somehow think that the market is taking it either too lightly, or maybe I'm thinking too much about it, and that's Hero MotoCorp. I don't know whether you can comment on it individually or maybe the two-wheeler space as a whole. But all that talk about workers saying that either the wages go up or they go and do a strike, and it's like being caught between a rock and a hard place, because even if they don't hike wages, then there's a strike. If they hike wages, then the operational costs go up, and this has been seen in other auto companies before in the stocks correcting. What about Hero?
Well, I think clearly on the one side, the entire space is going through a bit of challenging times, both in terms of volumes as well as in terms of the operational profit that is there, and which is one of the reasons why you're really seeing a company like Hero MotoCorp really ensuring that their marketing expenses come down by them not supporting a particular sport and the kind of spend that they used to have on that, and moving on to other sport where really the marketing does happen but the overall costs are lower. So really the point is the companies have now gone down to looking at what their operational costs are, ensuring that margins do need to get maintained at a time when volumes are really falling, and there's really limited sign of them turning around considerably, at least in the immediate future. So even for Hero MotoCorp, volumes to an extent have been affected, margins to that extent have been affected. My sense is over the next quarter or two, you'll probably not see a significant fall in margins because of the internal cost cutting that you're really seeing, or operational efficiencies that the company is trying to bring about. So there might not be a significant fall in terms of margins, but you might not, you're unlikely to see maybe a significant upping of profits in the absolute sense. So given that fact, unless actually volumes rise or there are new launches, you could just see that sideways movement happening in this stock as well.
Prakash, there are a couple of, there are 3 or 4 brokerages which have come out with downgrades on the two-wheeler space, and particularly in Hero post the numbers, and the piece of fundamental news isn't that great. I want you to look up the charts of Hero MotoCorp or a Bajaj Auto and tell me if they look weak enough to probably slide another 100-150 points from the current levels.
Actually, to me, both the two-wheelers look weak, starting with Bajaj Auto. It has seen a down move from 2,250 to lower levels around 2,000 levels. Did consolidate, I would say, trying to consolidate in these regions, but no, it did not. In fact, the structure that is evolving now looks like more of a breakdown structure. Just needs to break the 2,000 mark, which is the psychological support for Bajaj Auto. If that happens, where does it go? I think it will be a deep cut to maybe levels closer to around 1800 zones on Bajaj Auto. Let's look at Hero Motors. Hero Motor has seen some kind of a distribution pattern between 1950 and 1750 for a couple of months, and it's actually broken down. The structure between 2300 to 1800 structure is a weak, purely a distribution pattern. I think Hero Motors can slide down to levels closer to 1500. It may not happen in a hurry though, but it may take its own sweet time. But structurally, when I look at two-wheelers, they're not on right footing, I would say. They're both looking weak. Both are good shorting candidates or sell on rallies.